So, can you talk about some of the other maybe barriers that some people may not have the 2000 USDL or the enough pulse rather to come at it from a loan perspective? Somebody mentioned about, or maybe they could do this and just put liquidity into pools. Can you talk about some other ways to interact with this protocol?
Yeah, I'll speak on that for a second.
Get it.
So there's two places where you can essentially stake. Now, one of those is called depositing into the stability pool, but it's essentially a staking contract. So if you forget about the loans for a second, if all you do is accumulate LUSD from the open market, for example, you can come and you can deposit into the stability pool. And depositing in there makes it so that you're accumulating the reward release of loan tokens. Okay, so it's very simple. You just deposit your LUSD. You can withdraw it at any time you want to, but while you're sitting in there, you're earning loan tokens. There's a reward release pool. It's trickling out loan tokens to everybody who's participating in that staking contract. So you're just accumulating free loan tokens. If there's ever a liquidation on somebody's loan because they're under collateralized and they fall under 110%, they're going to lose their collateral, and their collateral is Pulse. And the purpose of that stability pool is to essentially pay off that loan. So you're going to be one participant in that stability pool. You're actually going to pick up a little bit of that ETH whenever there's that Pulse whenever there's a liquidation, and just a little bit of your USDL is going to burn itself. But at that moment in time, you're actually going to be up. You're going to be up in value just a little bit ahead because of where the liquidation point was. Liquidation point for that guy who had the loan, who was liquidated, that was at 110%. His loan value, right, it gets paid off 100% of his USDL that he had borrowed or he had minted, but there's a 10% gap in there. So that Pulse actually puts all the people in that stability pool just a little bit in profit at that moment in time. Now, the hope is that people aren't being liquidated all the time, that people make smart decisions. They over-collateralize. The system kind of forces the average health to be at least over 150. It doesn't prevent some people from choosing to under-collateralize. And there's actually reasons to under-collateralize. Sometimes people will do that to try and take advantage of an arbitrage opportunity. Other times, people just simply want to exit their position, and depending on slippage and price impact somewhere else, they actually may just say, you know what, I'd just rather be liquidated and take my USDL and go. So you will see liquidations from time to time, and when you pick those up from being a stability pool depositor, some of your USDL will burn, but you'll pick up Pulse in its place and a little bit more value than the value of the USDL that was burned. So that's one thing that you can do. And you can just pick up that USDL wherever you want to. You can grab it from a different lending protocol that may be lending it out. You could just buy it on the Pulsex, swap, Pulse forward or USDC or whatever you choose to. Just find USDL, bring it in, stake it into the stability pool, and then earn those loan tokens, and on occasion earn some Pulse. Something else that you could do is the staking pool for loan token. When you take loan token and you stake it into its staking contract, it just sits in there and you earn USDL every time somebody initiates a loan. When somebody mints USDL, a little bit of their USDL gets shaved off from, doesn't even go to their wallet. It goes to all the stakers of the loan token, right? So you're collecting the fees whenever somebody takes a loan. Remember, those people who take a loan, they don't have to pay a monthly interest payment, but they do have to pay a small initiation fee, a small funding fee, so to speak. And that simply gets shaved off and gets distributed to all the stakers of the loan token. There's another mechanism called a redemption, which is something that's in place to help arbitrage and peg the stability of USDL to $1. Whenever people are conducting redemptions, you'll actually pick up Pulse as well. So stake the loan token, and you're going to be earning primarily USDL. And whenever redemptions are occurring, you're going to be earning Pulse. You never lose your loan tokens. You can unstake them at any time and go do whatever you want with them. There's no staking time limits. You can stake for 5 minutes, earn, some USDL, unstake those loan tokens, claim your USDL and all the loan tokens you put in there and go about your way. It's up to you.
That's great. Yeah, no, fantastic. The first one is brilliant and clear. Park it there. So why not? There's really no downside to parking it there that is sitting in your MetaMask. The second,
there could be downside. Let me talk through that risk for a second. You will always want to monitor that position if you're in the stability pool. If there happen to be a wave of liquidations, let's say Pulse does like a 30-40% dip or something, and there's a whole bunch of vaults, 100 vaults or something that all get liquidated. It's great. You'll pick up all that Pulse and you'll be up in value. But you just lost your stable coin. If Pulse was to continue dropping another 10%, from the point at which you picked up that Pulse, you would actually start losing some value, right? Because Pulse is the volatile asset. So if you've essentially just lost some stablecoin and picked up some Pulse, if Pulse was to continue dropping, your stability pool position could start losing value. But just monitor it, watch it, and then you always have the choice whenever you do pick up Pulse, you could just swap it back out for more USDL or go add it to your own loan collateral or go do something else with it. Just keep that in mind.
Right. Yeah. So the redemption part, I was reading over, it's a 1-to-1. Is that how?
Yep. So this is actually one of my, it's all my favorite. I like everything about
favorite child.
But the redemption function is probably the number one thing that keeps the stablecoin stable. So the way that works, usually people are going to be swapping their USDL. They'll simply go off to a DEX, Pulsex, for example, and if they want to swap their USDL for Pulse, they'll do that. If they want to swap for USDC, they'll do that. But remember, USDL is just a PRC20. It's no different than any other PRC20. But something has to keep it stable and at a certain price. If you were a big player and you went even with USDC over to Uniswap and you dumped a bunch of it, you'll actually slip the price. You'll have a price impact, and there's a little arrow you can expand like right as before you do the swap, and you'll see how much price impact that you're essentially moving the price. All stablecoins function the same way as other PRC20s. If you dump a bunch of them, you're still moving the ratios, you're moving the price. So you will see that with USDC. You'll also see that with USDL. So on occasion, USDL, which usually is at $1, if somebody dumps a big bag of it, well, guess what? It may trade at 97 cents or 95 cents or even 90 cents or something. But it's not going to stay there very long because people know that if they have those in their possession, they can click the redeem button inside of Liquid Loans and get $1 worth of Pulse for it right from inside the protocol. So people usually race to the door. They're like, oh, look at USDL. It's at 95 cents. And they buy a big bag of it. They try and slip the price back up to $1. They come back into Liquid Loans and they click redeem and they type the quantity of all those USDL that they picked up. And then they get $1 worth of Pulse for each of those. And they just made that 5% profit. The math isn't quite that simple because there's a range in there, but that's essentially how that works. Now, where does that come from? Where do those Pulse come from? It's really interesting. So the lowest collateralized vaults, imagine the person who took a loan who's right there at the threshold, right above 110%. And he's the lowest or she's the lowest person on the totem pole. When somebody clicks a redemption, it actually grabs some of their Pulse. It gives that to the redeemer. It takes that USDL, it burns it, and then it clears that same quantity of debt from that person's vault. So that person loses some of their Pulse, but their debt is also cleared. The same value of debt is cleared from their position. And now all of a sudden their collateral health, instead of being right there at 110 point whatever, 110.5, now all of a sudden it's like, oh, wow, this person's at 112% collateral or 115 or whatever it puts them at. It raises their collateral health because it's essentially paying back their debt and getting them further away from that liquidation point. It stabilizes the system in that regard, raises everyone's collateral health. It repegs the price back to $1. and then you actually get to profit a little bit if you're the one who's doing the redemption.
Wow, that was so clear. When would I execute this? Well, not that I'm ever going to move any prices,
Right.
but
It
I
wouldn't be all the time. You'll actually get the best rate just by simple swapping.
yeah.
But if the price of USDL falls enough, say, down to 95 cents, there could be an opportunity there where you're like, okay, let me buy some of that and then just go and redeem it.
Well, the powerful thing that you said is that it helps the whole system when that does happen. And it gets that liquidation situation in better standing. So thank you. That was phenomenal as usual. Thank you so much, Jesse.
You're welcome.
I was going to say just briefly, I know those guys, their hands are up. I just want to touch on it quickly. So this will be very broad strokes. A few of the things there. One, the reason that LL can actually have that 110% as compared to between 130 and 150 in some different ways is because of the mechanics that Jesse's explaining there. Because those liquidations can happen instantly, and because there's redemption and things that help maintain that health of the system, that means that because those things happen faster, there's less risk to the system basically being under collateralized. And there's a lot that goes in there, but that's part of those mechanics there is what allows it to happen fast, because those liquidations, because of redemption affecting the essentially the least safe vault. These allow that to be down at 110% as opposed to 30 and 50. One, that makes it more capitally efficient for you to use. And also it means that there's, if you are liquidated, there's less risk because that spread is tighter. And then on liquidations, I know you'd asked that question previously, so I just wanted to touch on it really briefly. One difference is a liquidation in this system is not the same as a liquidation on a margin call, right? So if I'm margin trading and I get liquidated, that's wrecked. That's zero. Here, if you get liquidated, it means that vault is closed, but you still have whatever value it was you previously extracted. So I don't want to sort of say that, hey, liquidations aren't an issue or that you should just get liquidated no matter what, right? Like, of course, that's silly. But just to put it back in context, if you can use it in a variety of ways, and just, again, really high level. So say I want to collateralize at 150% or 60%, and I have some utility I want to use the tokens for and whatever I have going on. So if the price of Pulse goes up, okay, well, then I'm going to be at a more safe collateral level. I'm less likely to be liquidated. I could take more value a lot of places. If I'm wrong and Pulse goes down, I'm only negative if it basically goes down to a certain percentage, roughly between like 10 and 15% below that level because of the collateral and the small amount of the fees on both sides. Say that it went 20, 30% below. I would then be positive, right? It would essentially work as kind of like a slightly inefficient stop loss there. So even liquidations, if you sort of look at the chart and you say, okay, I'm safe here and I'm safe here and I'm safe here. Okay, this is where I get liquidated. There's only a negative position between that liquidation for a handful of percent of pricing before you would be back in positive again, where you could buy in cheaper depending on what you did with that other funds. So it's not meant to say, like I was saying earlier, it's not meant to say don't worry, don't be concerned, don't be diligent, but it doesn't mean that if that thing hits 110 that it's just nuke city and your whole stack is gone, right? Like there's utility around using those things, as Jesse was explaining.
Right. Yeah, I like what you said about why liquid loans can have a liquidation point at 110. Over in Maker protocol, which is where DAI is produced, you actually have to put up way more collateral, 130 or 150%, depending on if you're putting up USDC or you're putting up ETH. They are removing, or maybe they've already removed USDC as being able to be collateralized at this point. But imagine being liquidated at 150%, right? Initially, you probably would have gone much healthier. You would have gone 300 or 400%. But as the price of ETH fell and fell and fell, if you were to get liquidated and you lost like your bag and a half, you lost extra collateral, all that extra value that was just super inefficient. And the reason that DAI uses such a high liquidation point is how they handle the liquidation. They do what's called an auction, right? They send off the ETH to an auction. It takes 6 hours for the auction to complete. And the risk to them is that during that 6 hours, ETH could continue to fall in price. And if it fell another 50% in value, they'd actually go into an insolvent status there could potentially end up being something called a bank run. Everybody races to the door to sell out of their stable coin, and the stable coin goes to zero. So the way they've chosen to protect themselves is to just require the liquidation point to be up around 150%. That whole strange mechanism, that risk factor, was completely removed with liquidity and liquid loans because the liquidations happen near instantly. Somebody hits a button and the stability pool is there to absorb that liquidation instantly.
Great explanation, Jesse and Walrus.
All right. I've had a chance to play with the Liquid Loans protocol for 2 weeks now, and I really like how it works. When someone liquidate and then I get PLS because of the, the word right now, for the monies that I have in there, I'll get PLS for that. Usually, in order to get the PLS, I have to cash out into my wallet. My question is, why is there not a function in there to where you could either send it back to protocol without cashing out to either the loan token or to USDL?
The contract puts it into just a claimable status, and you have to click that button and you have to pay the gas fee, the blockchain gas fee to have that moved. If there's any sort of automation or whatnot that would, while there are protocols, front ends that do that for you, the standard front end there doesn't handle that gas fee for you. So you have to click it, you have to pay the gas, then it shows up liquid in your wallet and you can put it where you want from there.
I think you're misunderstanding what I'm asking. I do understand how the gas fees work to where it sends it to your wallet, but instead of sending it to the wallet, I would rather prefer to put it back to protocol without having to stop. Have you guys thought about that?
Without overtaking the space, I have, but that's not a standard function inside of the liquid loans contracts.
I mean, there are projects and products out there that are being built which will help automate, if you want to auto compound your rewards, etc. You will be able to do that, but the basic front end that liquid loans will provide won't have any of these auto compound functions. I suppose the whole idea behind it is, you'll learn how to do this yourself first and foremost. It's all self-custody. You're always in charge. It's your wallet. You mint the USDL. You get to decide, do you want to put that into the stability pool? Do you want to stake your loan? It's always you that's in control. Whereas what you're suggesting would obviously put a smart contract in control of all of that. I'm not suggesting it's wrong or bad in any way, but you'll have both options, basically. You'll have the standard with liquid loans, and then there will be others out there who will provide these products.
Okay.
There's also there's certain things like we've even seen with like Hex that a lot of us are familiar with. So like now we have like tradable stakes and some of these pooling stakes and things like that. There's also just certain features that you want to be sort of built at timing. So like, let's just take, again, it's just kind of a broad strokes. If you take like HSI stakes and tradable stakes, had you had that origination, that would change a lot of that early staking behavior. So there's always these features and different ways that you want protocols to scale, that you want different avenues for other people to be able to build different things on, that you even certain features you want available at certain times of progress, right? So would Hex essentially in some of these staking behaviors, would it have been shaped differently if things like Maximus and Hedron and HSIs and all these were available at origination? That would change staking behavior. So some of these things you want to make sure that there's room for growth at certain points, that there's space for people to build on top of certain things. So a lot goes into keeping some of those things in and out. Sometimes it's just simplicity, some of it's edge cases, gas optimization. Again, simplicity also basically relates to security. And then you'll see multiple front ends that get built for liquid loans that offer different aspects and different, sort of services for different players who want to interact with, compounding or different strategies. So a lot of times you want to make sure that you sort of have vanilla perfect, and then people can add flavor.
That makes total sense. Thank you.
Some of that is by design, right? So again, a lot of us, have Hex as something that we have to visualize, LL, there's still a level of like abstraction. So let's imagine that we all get to time travel back in time. We get to be OG Hexes. We're there day one. We get to know that there's a dip coming. We're going to DCA and all these things, right? Imagine how hard it would have been to not only come in early and make that decision and decide whether or not you think Hex is viable, but now you have to decide if tradable stakes make sense, or if you should wait for a pooled stake, or if you should wait for DESI, team, Maxi, all their variations. Like imagine this sort of paralysis by analysis if you give too many options in one place, right? So we see this in a lot of places in other industries, businesses, things that are successful. If I complicate this and give somebody too many options, they're just going to choose not to. Like think about how much time all of us had to sort of like, okay, I get hex, and there's staking, there's yield, build out a ladder, got it. And then things came along with hedron and HSIs. It's like, okay, there's a volume bonus. I collect. I got a mint before I end the stake. And now if I want to, now I can put some portion in these tradable stakes and NFTs. You know, how many people knew what NFTs were at the time? Where would you trade them at? Like now you just add infinite complexity to the beginning rather than saying, here's hex, it's trustless yield, come in and play stake. Okay, great, I got that. And you add and add and add, and you sort of allow these ecosystems to grow. You give other people incentives to come and build on the product and bring their own space, right? So sometimes people just build cool stuff, right? They build cool things, they add innovation, they add a flair to it, and sort of you get to where the whole is greater than the parts by allowing other people to add and build things and take ownership of certain sectors and to allow people to participate on a level that makes sense for themselves, right? So you can come in at, like you said, at Liquidity, LL, and it's vanilla. It's all right, cool, got it. 110 collateral, basic, understand. Here's the the stability pool. There's a few ways to engage. Got it. Then as you grow, you can go, okay, I really would like this thing to auto compound. Maybe I would like it to employ one of these strategies or do XYZ thing, or again, like chicken bonds and some of the crazy stuff that they're getting built on top now. But if you throw all that at someone in the beginning, they're just going to be like, man, this is too much going on here. Like, I'm just going to go buy Dogecoin. Like, so again, some of these things are by design. You want to give people creative space. You want to allow there to be more data points along the way. So even HSIs, we know they're a good idea now for the most part, right? There's a pretty good consensus. Did we know they were a good idea at origination? The same example I was using earlier with E 2.0. Now we know that it's holding billions and billions of dollars and it works great. Did we know that last October, right? So those data points allow for some of these features and things to be added in ways that are smarter than we even know right now. So compounding some of these things will be better off added in the future by other players for scale, more data. There's kind of a variety of reasons about making that ecosystem grow and be healthy. But it's a great question.
Very cool. Everything does make sense. Simplicity is as the foundation and then building on to that afterward. It definitely makes sense. I appreciate your point of view. It opens my mind to different things now.
100%. And that simplicity, again, simplicity when it comes to coding is basically also security, right? So if if you add all those things, we talk a lot about like smart contract risk. There's just risk to the fact that there's more stuff, right? Just by itself plainly in just the simplest way.
It is so easy to use. Like it literally takes less than a minute if you want to just deposit Pulse in your wallet, your T-Pulse, I should say. Just go in. It's so fluid and easy to use. So
I guess the question was having the USDL in the pool, and when someone else gets liquidated, say I get 5,000 PLS from their liquid, that brings the USDL that's in the pool down in price. From what you guys were saying, I actually watched it.
It actually just simply burns it, and then it clears that debt from that person's debt position.
Okay, but I still accumulate profit off, or profit's bad.
Right, because it's not actually swapping that pulse. It's not swapping and changing the ratios and driving the price of USDL anywhere. It's simply just spreading all that pulse amongst the stability depositors and then burning the USDL. The USDL ceases to exist at that moment.
Okay. So let's say the initial PLS that I put in, at least $5,000 DL. So after PLS goes out from a liquidation of someone else, and I decide to cash out afterwards, let's say it's down to 450 USDO. When I go to cash that out and put that back in my purse as PLS, will that still be around the same amount that was initially?
All right, so you're talking if you are participating in the stability pool with USDL?
Correct.
Okay, so you're in there with USDL. Somebody else gets liquidated. You now have less USDL.
Correct.
But you have that equivalent value plus a little bit more value at that moment in time worth of Pulse. If you choose to cash out or withdraw your USDL, you do have less than you started with. Okay? You can choose to pay back your own loan if you do have a loan with that. And you can always swap or sell your Pulse for the rest of the USDL that you might need or want if you wanted to go add some more USDL to paying back your loan.
Okay, so right, okay, that's the answer I need. Thank you. I tried reading in the white paper and it didn't make sense to me, so that just clarified it for me. Thank you.
Right, and keep in mind also, if you're capturing Pulse, that's because Pulse has gone down in value. Somebody's been liquidated. That doesn't necessarily mean that Pulse is done going down in value. It could continue to drop and decline and retrace some more. So you do want to monitor your USDL stability pool position, and then make a choice. When you do capture some of that Pulse, what do you want to do with it? Do you want to just hold it? Do you think the price of Pulse will go up? Because you'll be in profit at that point. But if you hold on to it too long and Pulse keeps going down in value, you could get into an impermanent loss sort of situation. But you have a 10% window in there to make that decision.
I definitely try to stay much higher than that. I prefer to be above the 500% if at all possible. So I'd rather not be liquidated. So
yeah, I mean, nobody wants to get liquidated. It can work in your favor. It's part of your strategy, but it could also be a disposable, cause you to pay taxes. So depending on where you live in your jurisdiction. So we always recommend not getting liquidated and going in and monitoring your vault at all times.
So when I want withdraw pay the debt that's owed, I watched in the chat and Telegram, someone was getting a little bit frustrated. They were trying to withdraw their PLS. They were trying to pay their debt. There was confusion as to, he didn't quite pay enough of his debt and he wasn't quite picking up on how he was missing that, he or she. So can you just be really clear on where you're looking at when you're paying your debt back, what that debt is? Because I know because of some liquidations that have happened, I have less USDL than I originally borrowed. So at some point, I'm going to have to swap some PLS, I think, somewhere, pay that back. But can you just really be clear when there's that $200 thing that sort of shows there?
When you obtain a loan, there's a set aside that you have that's a $200 fee to cover other people's expenses in the event that you're liquidated. If you're never liquidated and you pay off and you clear your entire debt, you get that $200 back. Okay? So that's one part. The other thing you have to keep in mind is you can never pay down less than $2,000 worth. You cannot hold less than $2,000 worth of debt. So if you've got a $5,000 debt, and you say, well, I want to pay back $4,000, it won't let you. It will only let you pay down $3,000. The last $2,000 you have to pay all at once. So you either the minimum debt you're allowed to have in the system is a $2,000 debt. And then I think the last point, which may help clear things up, and you feel free to ask additional questions. When you first mint and you first obtain a loan, there is a borrowing fee. There's a 0.5% borrowing fee. That does fluctuate based on the health of the system, but usually it's around 0.5%. And remember, that USDL goes to the stakers in the protocol. That's the fee that you pay to use the protocol, to potentially have a tax advantage loan, talk to your tax advisor, to be able to utilize your assets or some value that you may have without having to sell your Pulse, right? So there's a fee that comes with that. That's 0.5%. So if you try and pay back your loan and you haven't accumulated 0.5% somewhere else, you're going to find that you're short a little bit of USDL and you'll have to go buy some to pay back your loan.
That's exactly what happened. He was just practicing. He went in and out. It wasn't like he just put his PLS in there. He's trying to get his 10 million PLS out. And we all saw where he should have been looking on the right-hand side. It showed there was an extra, $10.50. Finally, he got it. Everybody amazing. In
Right.
the
Yep, his USDL went to the stakers. That's why he didn't have all his USDL when he backed out too quickly.
Tell me now, 2.0, is it open source right now? Like they can basically work on it? And what about Pulsex or 3 Uniswap? Is that license open as well?
V3 for Uniswap is not. It will be open in not that long, like 5 or 6 months. It's May or June, somewhere in that range. But the ETH is open source. It can be forked right now.
So basically, logically, you could think that Richard would wait till V3 is open, right? So you can integrate that in his Pulse.
No, there's really no need to wait for that. The same way you have like V2 now. So you don't have to have V3. V3 has some really cool advantages, and it's a reason it was improved upon. But you can add V3 the same way Uniswap was added later on. You just launched V3. It's no reason to hold up the network.
Gotcha. Thank you. Appreciate it.
For sure.
V3 works on testnet if you go to the standard Uniswap contracts. Now, granted, when the liquidity migrates over, most of the liquidity is going to be in Pulsex, but there's going to be some wicked arbitrage opportunities, and Uniswap V3 does function still on Pulsechain testnet, and it will on Pulsechain mainnet as well.
Right. So what Jesse is getting at is that V3 already works. Again, you can jump in, do all those things now. It just can't be added to Pulsex because of that licensing source, but the V3 will still be there and function.
Gotcha. I'm just trying to figure out the time frame for PLS long.
Hey, we all are, brother.
Thanks for your answers, boys.
Of course. Jesse, good to see you, brother. And then what is true? What's going on?
What's up, brother? I know there's no tax advice here, but one of my strategies I want is using liquid loans to invest in real estate. Because here in the United States, we know that we can take out a loan and we don't have to actually pay tax on loaned cash flow, right? So the question is how does that overlay crypto, which is kind of I don't know. That's just so much that I don't understand about that. So I'd love to be able to hear some thoughts on this subject.
That's it. Just want to know in general how all legislation will affect stables, when centralized currencies are coming, and overall how to use liquid loans for real estate. Those are pretty simple questions.
Yeah, that's it, bro. That's all.
Easy peasy.
So the tax one is tricky. There's a handful of things, and I know it sounds standard and a cop out, but always go talk to whoever your professionals are. There's the standard procedures around a loan, which is not a sell. And so you would say that, hey, this loan is not a taxable event. The other is that because it's not asset to currency and a few of those things, and like crypto to crypto isn't really recognized, then there's this other side that says, well, no, it's not. That is a tax event, right? That however you guys want to sort of drop your internet money from one internet money to the other internet money, that's a taxable event. The other is where they talk about having like an arguable position, in which case that kind of gives you a defense if you get audited or have to defend a position. You basically have a case that can say, again, within reason, being very high level, hey, this is my position. This does make sense. You're saying I'm wrong, but that's not the same as basically doing something illegal in some regards, right? Depends on where you're at. And this, that precedent takes place in a lot of different positions when it comes to complicated law, especially where the case law is not especially relevant. So on the tax side, it is slightly Wild West, and you could sort of point to things on both sides that say, hey, this has the clear advantage that you're asking about, or no, that's ridiculous every single time, no matter what, it's not going to save. The two things that I would say is, one, always make sure that you have a professional look for two reasons. One, trust the professionals, not the walrus in the Twitter space, the rest of these guys. And the other is that, again, if you get to that arguable position, you can say, well, hey, it's a loan. You can point to some of those statutes, and you can say, I went to a professional as well. So it kind of broadens your case, right? If you do get into some issues. So, and then the other one is to always be consistent, right? So don't call it one thing here and then another thing here and then one thing here and sort of try to take, well, it was kind of a sell here and it was kind of a buy here and here it's actually a loss and here I participated in this way. You want to be consistent, right? So if you call whatever, this is all transactions in crypto. If you call a transaction type A type, this was a sell, this was a loss, this was a buy. You want to be consistent across the board and not try to cherry pick. Or again, you kind of get to the point of, if you do have to go down that line, it's really hard to say that you were arguing in good faith when you were just kind of cherry picking the statute that made your case.
That makes sense. Perfect sense.
For sure.
Just to add what is true. So when you do take a loan, like you said, in normal, like in real estate, if you take a loan out of a HELOC, if you take a loan out of your 401k, you pay a fee to set up that loan, and then you pay monthly payments and interest on it, but you're paying the interest back to yourself in a 401k, for instance. But you never pay taxes on that. So you have other things to back up your claim. Like Walrus said, though, just be consistent. That's basically the way the law is interpreted now, but always check with a tax professional. The nice thing about liquid loans is there's 0% interest and no payments to make back on that either. And then the other thing is, until we have a direct fiat off ramp, you would probably have to swap it for another stable coin, say USDL to USDC, and then over to Coinbase or however you're going to get off. So that transaction could be a taxable event depending on your jurisdiction. But what is $1,000 swapped for $1,000? What's the net loss or net gain on it? Zero. So you may have to claim it. Maybe it behooves you to actually report it. But if there's no net gain or net loss, there's nothing to report, or there's nothing to pay, I should say. So that's the way we've been looking at it. Until the legislation is clear, or, like I said, always check with your CPA. That's basically how I personally am going to be interpreting it.
And as always with a lot of these things, sometimes people like to get, I always like that term, like too cute. And so, if you're talking about 10 grand, no one probably cares. If you're trying to get too cute with 10 million, somebody cares, right? So that's another one of those things in scale that, that's not to encourage anyone to do one thing or the other. It's just another one of those things to look at. We always talk about like, what's the risk to principal kind of thing. So, if you give me $100, maybe I just decide to go to the casino and roulette wheel these things. And I take things that have extremely high range of outcomes. But if you give me $100 million, you can't touch my money. Like now I'm just going to sit it somewhere in the most conservative way and take the yield. So with all these things, you want to kind of factor in that risk to principal as you make these decisions, whether it's, what currencies, leverage, tax advice, all these types of things. So take the amount of principal you have there into account as well. And then just on the stable coins, this is kind of like, I feel like this is my standard answer to like half the things in crypto as well, is I'm not especially worried at the moment, but I always try to tell everyone that I also do want you to be worried, because we should always have that strong level of skepticism and concern, because things in crypto move fast. Legislation can be very much not what you expected. And you never want to be, too exposed to these things. You want to be safe, right? And again, that changes with the amount of principal you have. So the way LL is designed, being over collateralized, very limited governance, having, being a fork of something that's been shown to be very productive on other chains. To me, it's sort of the last thing in line that I think that would become and get, swiftly handled with jurisdiction. But again, that's my speculation, right? Like, I don't get to hang out in the House of Representatives or Parliament or any of these things. So I don't really know what's in their head, but that's sort of my best assumption from the outside, that the things that have broken have not been from these types of liquidations. They haven't had these types of safety. They had more governance, more centralization, and they've wrecked and broken. And kind of back to the, kind of arguable position. Usually it kind of comes down to, like, again, even with some things around securities laws, a lot of these things, some of it is just what happened, right? So if you design something and it works well and people are using it as intended and no one lost money, well, to some degree, that gives you a much more defensible position than Luna, right? Okay, now this is hard to discuss, right? Like now you have a bad actor, lots of centralization, huge amount of corruption, people taking hundreds of millions of dollars, a huge group of people that it's wrecked. That's pretty hard to defend, even assuming that you said that this was, lightly inside of some gray lines. Okay, well, this is a hard thing to defend at this point, right? Well, if you look at LL, and as we assume, everything works great. The dApp's there. The product's being refined. It's easy to communicate with the dev team, their docs. Everything's on the up and up and things are working well. We've got better things to do than come bother people who are building productive stuff in general, right? But again, I always like to encourage people that I try to give my best input on those things, but that's not to merely make people feel comfortable. It's to make them feel less worried. I always want people to still be, on their toes and very, very skeptical and very safe in all their interactions.
Awesome. I love you. You guys are awesome. Thank you so much. And then last, notorious CBDC, your thoughts?
I have some thoughts on CBDCs. What's interesting is, they're going to be centralized, of course, but there's still going to be ERC-20s. There's still going to be tokens on the chain subject to liquidity pools and the same any price impact and slippage or vulnerabilities that any other ERC-20 is going to have. So what I've noticed throughout the years is usually governments are behind, in their technology and their software, right? So am I personally going to trust the CBDC to be more safe than something like LUSD or USDL or USDC? No way. They can introduce that stuff into the markets and it's going to have all the same exact risks, plus the centralization risks that things such as USDL and DAI do not have, right? That's just my quick take on the government's position, on these CBDCs.
Jesse, just off the back of that, what's your thoughts on the possibility of some USDC coming a CBDC that's centralized? They've got admin.
Well, the government typically outsources all sorts of stuff, right? Because they can't figure it out or they don't have the manpower to build stuff themselves. So I think usually governments get like this knee-jerk reaction where they see, civilians, so to speak, building cool technology all around them. And then they say, oh, wait a minute, we can profit off of that. Or we need that technology for our own uses. But then they realize, oh, we don't have the people that can actually do that. So then they just start looking around and they, sign contracts with organizations that have already put something in place, such as Circle and USDC. It wouldn't surprise me. It wouldn't surprise me one bit if we heard one day that Circle signed some sort of contract with like the U.S. government.
Well, yeah, I mean, they're heavily involved with mortgage, all sorts, so it kind of, in my perspective, it looks like it's going down that route. I saw some reports or so ago where some, they even said, look, we've tried to invent our own or design our own CBDC. It's not working. These other stable coins out there are working. We're better off just going with them.
The only thing that I would add to this is, again, more of a general take, because I pretty much agree with Jesse's take on that overall. We kind of see what they're doing. They're typically behind. I can't imagine that there's something especially beneficial to something that has all the same risk plus centralization. Like that's kind of that's what we were doing in the first place, right? Like we wanted to build things that has less externalities, less centralized control, especially from governments. So again, maybe there is some, tangible use case in the future, but I mean, again, I'm more likely to use the things that we're building now. The other is that in general, when it comes to censorship, centralized control, just kind of a life lesson in general is a lot of times your power in the deal comes from your ability to say no. And so, again, if you're, at your job, how much you actually have to do what your boss tells you in a lot of ways is controlled by how much do you need that next paycheck. So sometimes that financial freedom, that we talk about isn't just to go kayak around, Belize or whatever it is. Sometimes it's just like, hey, I have enough in the bank. I have enough set back that I just don't have to go do these things in a relatively respectful legal way on these things. So being able to be not just decentralized as far as currency, but decentralized as far as the jurisdictions that you're in, whether that means, if every single thing, I'm in Austin right now. If every single thing I own is in Austin, if I do something that makes the Austin, the jurisdictions here in Texas mad, everything I own is here, right? So again, everyone has families in different cases, but I would just, in a lot of times, look at how you're centralized in other aspects of your life and not always just focus on the currency, because your ability to disengage from these systems or to choose other things or to not have everything under one branch where, your money is decentralized, but then everything else you own isn't. So I would always try to view some of these things as what is my options to not engage with something I don't like.
I knew that blockchain was going to be the future. I didn't even know anything about it, but I looked at it, man, this is huge. But I never jumped in, and then something nudged me, and I jumped in, and I'm in pretty deep, man. I mean, I actually sacked Liquid Loans. I sacked for Pulsex. I've gotten amazing protocols. Some of them, about half of them, I'm waiting on, holding quite a bit of hex, and got my ladders going, and feel like we're in a pretty good position. And I believe that there are a lot of things that we can do with the amazing wealth that we have right in front of us. I don't think our window is that long, to be honest with you, even though I believe that we're still in the beginnings of this. What is it? 5%, roughly 3 to 5% of everybody in the world is in crypto. That's nothing, right? We don't even have adoption right now. So I think on the next bull run, hopefully we'll get there. It's going to be absolutely massive. And I plan on building a lot, because he's right. If we don't, crypto's amazing, sure, but you got to build and you got to make stuff. That's what makes the world go.
100%. But I don't write code. I can't build E2 consensus. I don't understand what Vitalik is saying any more than anyone else. We've all just tried to find roles in the community to keep helping things build, whether it's, sometimes it is just business acumen. I think that's a huge thing that crypto needs. I think we can take some parallels. They have similar things, like the marijuana business here in the States. When they first came about, there was huge profit margins, but there was so much, issues with law, and there was so much sort of polarization and stigma around it that in some ways it held back innovation and things, but it kept developing, and it brought out really strong voices, even people who said, hey, I don't even really support this, but I support their ability to do these things. And so it was in its infancy, and you could see that there was a lot of, legal back and forth, that there was and because you had someone in that business actually made the joke that they have white collar and green collars in that industry. And so you had people that cared about the plant and growing and the medicine and doing cool stuff. But again, that was what they did. They were poor businessmen, and most people are. So businessmen came in and started basically helping those green collars build constructive businesses, make better products, and scale on and go do cool things. So there's, pancake swap is still a huge thing. It's great code. It's fine stuff. I'm just teasing them. But, there's still a lot of immaturity in the space. So business acumen and coming in and helping people who can build cool stuff actually get to market and all these things, that's very standard in most industries. And we're at that point where we'll see more and more of that in crypto. So good on you, man. Like the whole space is happy to have another competent person in here doing cool stuff.
Yeah, I'd like to just welcome you to the community, man. 4 months, like I've learned the most in the past maybe 14 months, and I've gotten to crypto in 2017. But just being in this community, like I think we're the best, but it doesn't mean we should shut out the outside world. We want to try to get people to adopt and bring them in. But I think we're by far the most educated. There's people willing to help you all the time. There's many places to go to find information. They're doing Twitter spaces all the time. I think you're in the best community to learn. And with the attitude like that, like going out and building things, if you get $100 million, what are you going to do? Just go sit on a beach forever? I mean, that'll be great for a year or two, but you'll still want to have something else that gives you a reward. Helping other people and solving problems is what gives meaning to life. So, I think it's great that you have a whole good mindset about that.
Yeah, I appreciate all the, I've been listening to Cryptographics, and he's been doing stuff about, I forget the terminology, but essentially when you come into a large amount of money, you don't know how you're mentally, emotionally going to handle it. And it's been something that I've been to. I've got a good CPA that I trust. I've got a good lawyer buddy that I've known for a long time. I've talked to him. I've even talked to some very good friends outwardly hold me accountable. Because even though there's been times in my life that I've worked my butt off and have had some chunk money here and there, I've held it well. But this is a whole nother caliber possible. I mean, everything that I'm seeing, everything that I'm hearing, all the research that I've done, the X's that are potential in the space, unbelievable. I haven't seen any because I got in the beginning of the bear market, so I've just been buying them. Haven't really made a dime. I'm a holder. I'm definitely not a trader. I kind of got that, and I agree, man. This space is amazing. People that, and unfortunately, I haven't really met any personally. Just been doing stuff like this and commenting a lot. But just listening to interviews, seems like people's, for the most part, their hearts and minds are in the right space, wanting to help others. I mean, obviously that helps build everybody's bag, but the knowledge, the wisdom that's being brought forth, and ecosystem, hats off to everybody here. I so far, man, and this isn't a bear market. I can't wait until we start actually making money. It's gonna be amazing.
Oh man, when things were pumping a year ago, everybody was happy, so it was great. But yeah, it's called sudden wealth syndrome. I think that's what you're referring to. Matty Allen has talked about it a lot because he has a mental health background. But Cryptographics may be talking about it too. He actually was on a podcast I did a podcast. I have a show, Hexacat Chats. He was on 2 episodes ago, I think. So we didn't talk about that, but he's a great member of the community. Very positive, good attitude. Yeah, when the market turns, you're in the right spot to be accumulating. This is now whenever you have any extra seed money, now's the time to be investing or just at least loading up on like USDC or USDT, whatever stable coin you can get ready, just so when things do start to turn, you're positioned and you're well ready to go. Because it's going to happen eventually. Even Richard says that on the last stream he did. So it's an exciting time. And the X's that you can make in crypto, I mean, you might do the S&P 500 and make 3X over 30 years, maybe a 10X. But crypto, you can do that in one day. So, welcome to the community. I have a question. Have you heard from anybody who planned on being a validator, how they feel about this stuff? I haven't heard anything personally from Feeder or any of those guys. Does this change their thinking?
Well, we have a validator, right? We've had one. Yeah. So we've had one up. So ours, we had, kind of a little behind the scenes, we actually didn't run that high end of hardware relative. If I remember correctly, Feeder, I think Rack, 2 or 3 other people had basically said hey, we're going to be the cat's ass validator and build really cool stuff so that we never, that we're future proof, we're great. We didn't have anywhere near that level of hardware, and we were going to upgrade in the future. We kind of had hey, let's get our feet wet, let's process and we'll move on. So the requirements are obviously ridiculously lower on E2.0. Some people, I think, are, again, Feeder and those guys might have a different position because they have a substantially different level of investment. What we'll likely do is we'll probably just run what we have because we were sort of close to the minimum requirements. Again, we knew there was a test net. It wasn't going to be very tasked. If we screwed something up or it wasn't enough, it'd be fine, right? It's not real money, right? This is all playing and testing. So we may scale ours back to some degree if we can, recoup enough value that it matters. Honestly, we probably won't mess with ours. But back to that analogy where I was explaining, kind of like the Bitcoin Cash versus Core, the hardware requirements will tend to go up at least to some degree. And I don't really know how the scaling there quite works. It's a little above my head. But as we add shorter block times, as we add gas limits, as we do these other things to make the network more powerful, as we upgrade the motor, right, the hardware requirements will go up. So I think some people that built things closer to what we built will probably just essentially be overbuilt now as validators and rock and roll and call it is what it is. Cats like Feeder and Rack, I'm not real sure. They definitely have, I mean, they have enough. Feeder could probably run like 100 nodes, and I'm not exaggerating. No, something asininely high. So those guys might, do whatever it is those guys do. They might sell some of it off, or maybe scale down, or maybe they just basically are future proof forever. There'll be kind of a variety of explanations there.
Awesome, man. Thanks for the explanation.
I think, jokes aside, I'm pretty sure that Federer could actually run like all of U.0, just like out of his house apparently with the thing he built. He might just run the whole thing and just be like, guys, it's cool, I got it.